Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy. If you've been following the channel, you'll know that I recently posted a video talking about the fact that inflation has been falling in the past 3 months. And the official 12-month inflation figure for November was only 0.2%. And the reason that represents a problem is because it means that companies in China are currently unable to pass on cost increases. So the cost increases that they've seen in their raw materials and also the wage increases that have been passed over the past 12 months, they're having to absorb. And that means that their margins have been cut, and many companies, it's estimated that almost 50% of companies in China are currently making losses. And the monthly inflation data, which measures the change in prices from one month to another, shows that China is actually in a deflationary situation at the moment. In October, prices fell month on month by 0.3%, and in November that doubled to 0.6%. And that continued downward pressure on prices continues to push down producer prices, also known as factory gate prices. And in November, factory gate prices were down year on year by 2.5%, which means that companies in China today are selling their goods for 2.5% less than they were this time last year. One of the ways that the Chinese authorities are trying to turn around this economic slump is by encouraging consumers to go out and spend more. And let's not forget that there are 1.4 billion people in China. It's the second largest country in the world in terms of population. But unfortunately for the Chinese authorities, retail sales unexpectedly fell in November to 3%. And that's the lowest level that's been seen since August. And if we look at the month-on-month movement in retail sales in November, it represented an increase of only 0.16%. And you can see that the trend for October and November is significantly downward. And that slowdown in retail spending was despite the fact that a lot of retailers in China had discount periods on during the month. So they were heavily promoting their goods, trying to encourage people to come into the stores and buy. And this is a very worrying trend from China's point of view because it only has two ways of boosting sales, either through domestic demand, through retail sales, or through exports. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the last 6 months. And what this chart shows is that since the end of September, the value of the yuan has fallen by almost 5%. Now, if you're a regular follower of the channel, you'll know that I've spoken a lot about the value of a currency and how it links to the strength of your economy, mostly talking about the Russian ruble. And the generally accepted principle is that if your economy is doing well, then generally speaking, there will be demand for your currency. Other countries will want to deal with companies in your economy, and therefore the value of your currency will rise. So if your currency is going up, it usually means that your economy is doing well. If your currency is going down, it usually means the opposite. And what we've just seen in terms of the Chinese yuan is that over the past couple of months, the value of the yuan has been falling, and that tells us that there are issues in the Chinese economy. Now, one of the only benefits when the value of your currency falls is that it means the cost of your exports also goes down. They become relatively cheaper, and that can help countries like China in terms of boosting the total volume of their exports and increasing revenue. This chart shows the year-on-year movement in the total value of China's exports over the past 12 months. And what you can see from this is that in October, alongside that fall in the value of the yuan, China saw an increase in its total volume of exports of 12.7%. However, the latest data for November shows that despite the fact that the yuan continued to fall in terms of its value, the increase in China's exports was only 6.7%, which is only around half of the growth that was seen in October. And once again, this is a very worrying trend for China because despite the fact that its exports are becoming relatively cheaper as a result of the fact that the yuan is falling in value, the growth in those exports isn't rising as rapidly as China needs it to. This chart shows the year-on-year movement in China's imports, and the reason why what's happening with imports is a really important metric is that China is importing a lot of raw materials which it then uses in its manufacturing processes before exporting goods. So what's happening with imports gives us a very good heads up as to what's likely to happen with exports over the course of the next 3 to 6 months. And what you can see here is a very clear trend. Over the past 4 months, there has been a slowdown in China's imports. And in October, the total value of imports fell by 2.3%, and that fall accelerated to 3.9% in November. And that tells us that if Chinese companies are importing less, then they will have less raw materials to process and therefore are likely to export less goods over the next 3 to 6 months. One of the main reasons why the Chinese economy is having problems right now is because of what's happened in the property sector. I've talked about this a lot, but in the first 20 years of this century, there was a huge boom in the property market. Chinese consumers couldn't buy enough property, and it's estimated that 70% of all of Chinese consumers' wealth is held in real estate. So basically, they've invested into property as a long-term growth plan. However, unfortunately, over the past few years, we have seen the property market nosediving. And because of that, Chinese consumers are feeling battered and bruised. They've put a lot of their wealth into something that's now declining in value. And that's one of the reasons why Chinese consumers are not spending as much as expected in the stores, because they don't feel as wealthy as they did 3 or 4 years ago. This chart shows the year-on-year movement in house prices in China. And what you can see from this are two things. Firstly, house prices have fallen in every single one of the last 12 months, which is obviously bad news if you're a property owner. And unfortunately, that fall in house prices has been accelerating. And the latest figures for November show that year-on-year house prices are down by 5.7%. So if you'd bought a property this time last year, it is now worth less than when you bought it. And if we look at this chart, which shows the year-on-year movement in the value of new home sales, you can see that in 11 of the last 12 months, there has been a reduction in the value of new home sales. There was only an increase in October. However, in November, that increase has been reversed, and the total value of new home sales is down by 6.9%. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening with regards to retail sales and the housing market are absolutely critical to the future success of the Chinese economy. If you've been following the channel, you'll know that China has been struggling for the last 9 months or so to achieve its 5% GDP growth target for 2024. And there is a major question mark as to whether or not China will achieve that figure. It needs a final quarter to come through and be better than 5% in order to get there. And what we've seen from today's data is that the two avenues that China needs in order to achieve that growth, retail sales at home and also export sales, are under-delivering. They are not coming in at the level that China needs it to in order to get to where it wants to. The growth in retail sales has come in less than expected in November. This has been a shock to the market, despite the fact that a lot of Chinese retailers offered big discounts to consumers in the month. So they were trying to encourage people to come into the stores, but it just hasn't happened at the levels that China needs it to. And one of the reasons for that is because Chinese consumers have invested heavily into the property market. Over the last 20 years, they saw that as the holy grail. You really couldn't lose money. Put money in, the price of property goes up, and you make more money, you feel more wealthy, and therefore you're likely to go out and spend more. However, over the past few years, we have seen a reversal of that. We've seen from the data that house prices are down year on year, and they've been falling for more than 12 months now. And also, total new sales are also down. So the property market is shrinking at the moment. Nobody really wants to buy property. There are very few incentives in order to do that. A lot of people are sitting nursing their losses over the past few years. And as a result of that, Chinese consumers are now becoming more cautious. They're keeping their money in the bank. They're not spending at the stores. And this is really bad news from China's perspective. So the only way really for China to turn the corner would be to increase their exports. And the fall in the value of the yuan gives China hope that it could actually increase exports to the point where it would deliver that 5% GDP target. However, as we've seen from the exports data, the growth in exports is now slowing down. And if that trend continues, it's going to prove really problematic from China's point of view going into 2025. So the overall summary of today's video is that the latest data that we've seen on retail sales and the housing market confirms that the problems in China are continuing. China is struggling to be able to hit its GDP target for 2024, and there remains a huge question mark over what China is going to achieve in 2025. The Chinese authorities really need to come up with a stimulus package to boost the economy, but so far the announcements that have been made over the past month or so have underwhelmed the market. Nobody believes that the actions that are being taken are going to deliver the growth for 2025, and if China does underachieve in 2025, it's likely to have a knock-on impact to the global economy because it's the second biggest economy in the world. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.